Stephen Englander is Managing Director, Global Head of G10 Forex Research and North American Macro Strategy at Standard Chartered Bank. Stephen, great to have you with us here. Good morning. Thank you very much. So, on a day-on-day basis, no real cues here because U.S. markets were shut. But are markets in the U.S. also looking a little fatigued, Stephen? What's the overall sense? And where do we go from here in the near term?
Yeah, I think that's one way of describing it. I think the market's a little bit worried that they got enthusiastic about the Fed rate cuts too fast. Not that, we think they're gonna do 25, we think they'll do 75 by the end of the year, but the market's pricing in 100. And most of the economic data haven't come in really consistent with the need to do 50, certainly not in September, maybe not in Q4. So I think the market's beginning to be a little bit nervous that maybe rates went a little bit too far, dollar weakness went a little bit too far. And they're looking to the numbers that are coming out this week to either confirm that the Fed is going to cut, at a steady pace, but not as aggressively as priced in, or whether the U.S. economy is as soft as some people say. We're kind of in the 25 basis points through the rest of this year, 25 basis points per meeting through the rest of this year, Cam.
Okay, so maybe gradual rate cuts. That's what we'll see ahead. Stephen, hi, great to have you on the show. Now, what about the carry? I mean, the early August unwind and all that mayhem that was unleashed on the market, and then there was some talk about that, even the Swiss franc carry was unwinding. So where are we with all of that now? If the expectation is that we'll get gradual rate cuts and the expectation is, maybe somehow they'll steer a soft landing, what about trading bets and positions? What do you see around?
We think the dollar could strengthen in the short term just because of all the factors that I mentioned, that maybe it went a little bit too far. But we think the market's basically right, that by the middle of next year, we're going to be at 3.5. That will erode the U.S. rate advantage tremendously, both in nominal terms and in real terms. So we think that, say towards the end of this year and certainly in 2025, it will be a weak dollar year. Question, is it a carry trade or is it the dollar unwind trade? It's, often they're used to mean the same thing. It's not quite the same thing.
Hi, Stephen. Let's talk about, the Indian markets as well as the Indian macros. How are you reading, data points? Because GDP is fairly okay. Inflation has cooled off a little bit. So my question to you is, how do you see the RBI reacting now? We'll have the Fed that will be cutting, which is always good for an emerging market like India. And your view on the macros, how they're shaping up?
Well, we think that the RBI is going to cut twice, once in Q4 and once in Q1 next year. So it's not a terribly aggressive forecast. We don't think that the INR is going to move very much. We think there's going to be a lot of stability, which may be good for other Indian markets, but we don't think that the FX market is going to be particularly exciting.
Got that. Stephen, a quick conversation this morning. Appreciate you joining in. And it's a pleasure having you here on CNBC-TV18. So that's a global picture. As we've been saying, later this week on Friday, we get the jobs data. And then maybe there'll be a bit of fireworks as well. I hope not too much like we had after the last one. But it's an important data point nevertheless.